Hi, I'm Jonathan Wild. In this video, we are going to cover how to prepare and post journal entries. So first, let's quickly cover debits and credits. In accounting lingo, debit refers to the left side and credit refers to the right side. Whether a debit or a credit increases or decreases an account depends on if it is an asset, liability, or equity account. Assets are increased with debits and decreased with credits. Liabilities are decreased with debits and increased with credits. Now, when it comes to equity, it depends on the account. Common stock is increased with a credit. Dividends, on the other hand, is increased with a debit. Revenues are increased with a credit, and expenses are increased with a debit. So again, whether a debit or a credit increases or decreases an account depends on what type of account it is. Got it? Good. I think we're done. Just kidding. Let's run through some examples of how to record and post journal entries. So let's assume a business is just starting out and the owner invests $50,000 cash in the business. To record this entry, we debit and increase cash for $50,000 and credit and increase common stock for $50,000. We also see that after recording the entry, we post the entry to the ledger accounts. After the investment, the business then purchases $5,000 of supplies on credit. This means that the supplies are received right away, but we will pay for them later. To record this transaction, we debit supplies for $5,000 and credit accounts payable for $5,000. We debit supplies because we debit assets to increase them. We credit accounts payable because credits increase liabilities. The $5,000 being posted to accounts payable reminds us that we must pay back the seller. After that, the business purchases equipment for $12,000 cash. We debit and increase equipment for $12,000 and credit and decrease cash for $12,000. This is essentially an exchange of one asset for another asset. Posting the $12,000 to the ledger accounts, we see that the credit reduces our balance in the cash account. Next, the company provides advisory services to a customer and bills them for $8,000. Because we did not receive cash right after providing the services, this creates an accounts receivable, meaning the customer owes us money. To record this transaction, we debit accounts receivable for $8,000 and credit advisory revenue for $8,000. We debit accounts receivable because debits increase asset accounts. We credit advisory revenue because credits increase revenue accounts. The $8,000 is posted to accounts receivable to remind us that customers owe us money. Several weeks later, when the customer pays us back for the $8,000 worth of services, we record a debit to cash for $8,000 and a credit to accounts receivable for $8,000. The debit to cash increases that asset account, and the credit to accounts receivable decreases that asset account. The repayment does not change the total amount of assets and does not create any new revenue. It converts one asset, the receivable, to another asset, cash. That's it. Next, we have to pay our employee wages of $4,500. To record this entry, we debit wages expense for $4,500 and credit cash for $4,500. We debit wages expense because debits increase expense accounts. We credit cash because credits decrease asset accounts. Posting the $4,500 to the ledger accounts, we see that the credit further reduces our balance in the cash account. We also need to make a partial payment of $3,000 cash for the supplies we purchased earlier. If you remember, we initially recorded an accounts payable for the transaction. When making the partial payment on the accounts payable for the supplies, we debit accounts payable for $3,000 and credit cash for $3,000. This payment does not create an expense, even though cash flows out of the business. Instead, the expense will be recorded after we actually use the supplies. To reward ourselves for all of our hard work, we take $500 cash out of the business for personal use. To record this, we debit dividends for $500 and credit cash for $500. The debit to dividends decreases total equity, and the credit to cash decreases total assets. After that, the company receives $10,000 cash in advance from a customer. In return, we agree to provide advisory services to the customer over the next few months. To record this entry, we debit cash for $10,000 and credit unearned advisory revenue for $10,000. We debit cash to recognize the increase in that asset, and we credit and increase unearned advisory revenue to recognize the liability we have to provide those services. We do not get to recognize any revenue until we actually provide those services. Next, the company purchases a 12-month insurance policy by prepaying $1,200 cash. To record this transaction, we debit prepaid insurance for $1,200 and credit cash for $1,200. We debit prepaid insurance to increase that prepaid asset. This payment does not create an expense, even though cash flows out of the business. Instead, the expense will be recorded as the insurance coverage expires. In the end, or at any point in time, we can take all of our ledger accounts and their balances and put them into a trial balance like the one shown here.